Ladies and gentlemen, good day and welcome to Q1 FY26 earnings conference call of Lumax India Industries Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements do not guarantee the future performance of the company. It may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anmol Jain, Joint Managing Director for Lumax Industries Limited. Thank you, and over to you, sir.
Thank you very much. A very good morning, everyone. I hope everyone is doing well. Along with me on this call today, I have Mr. Raju Ketkale, CEO of the company, Mr. Sanjay Mehta, the Group CFO, Mr. Ravi Teltia, CFO of the company, Mr. Naval Khanna, the Corporate Head Taxation, and Ms. Priyanka Sharma, Head of Corporate Communications, along with SGA, our Investor Relations Advisor. We have uploaded our earnings presentation on stock exchanges and company's website. I do hope everybody had an opportunity to go through the same. I'll begin by giving an overview of the economy, followed by an overview on the overall automotive industry before we get to the company performance. India's economic journey remains strong, making it the fastest growing major economy in the world today. To put things in perspective, for the year 24-25, India's real GDP growth is estimated at 6.5%, and the Reserve Bank of India expects this robust pace to continue into FY 25-26. What's particularly noteworthy is that this growth is taking place against the backdrop of global uncertainty, highlighting the resilience and consistency of India's economic momentum. Coming to the performance of the auto industry, growth in the automobile industry has been relatively muted, which stands in contrast to the broader momentum of India's economy. This is largely due to industry-specific headwinds seen currently. There's a noticeable pause from several OEMs on aggressively pushing forward with electric vehicle launches. One of the key reasons is the limited availability of rare earth magnets, critical components for the EVs. China, which processes over 90% of the world's supply, imposed export restrictions in April, creating a significant supply bottleneck. In response, many OEMs are now exploring alternative sourcing options and are likely to resume full-scale EV plans once these constraints begin to ease. Talking about the industry performance for the quarter, according to SIAM, passenger vehicle sales crossed the 1 million mark in Q1 FY26, reaching 1.01 million units. However, this represents a slight decline of negative 1.4% compared to the same period last year. Interestingly, utility vehicles now account for a dominant 66% share of the overall passenger vehicle segment, reflecting a clear shift in consumer preference. While domestic sales have been relatively muted, exports have provided a bright spot. The industry recorded its highest ever Q1 exports of 2.04 lakh units, marking a strong growth of 13.2% over Q1 FY25. This export momentum was supported by steady demand across global markets, especially in the Middle East and Latin America. Additionally, recovering markets like Sri Lanka and Nepal, rising demand from Japan, and growing trade under FTAs such as with Australia further boosted this segment's performance. Turning to the two-wheeler segment, Q1 sales stood at 4.67 million units, reflecting a year-on-year decline of negative 6.2%, largely due to inventory corrections across the industry. On the export front, however, two-wheelers showed robust recovery with 1.14 million units shipped. Exports grew by 23.2% over the same period last year, still below the 22-23 peak, but a strong sign of resurgence driven by recovering neighborhood markets and sustained demand from key global regions. As for commercial vehicles, the segment reported a marginal decline of 0.6%, with Q1 sales totaling to 2.23 lakh units. Within this, passenger carriers saw growth, indicating continued investment in public transportation. However, the goods carrier segment recorded a slight contraction. Looking ahead to Q2, the industry maintains a cautiously optimistic outlook. While some of the headwinds from Q1 may persist in the near term, a combination of positive macroeconomic indicators and seasonal tailwinds gradually getting into the festive season is expected to support a gradual recovery. On the company front, Lumax Industries has sustained its strong momentum this quarter, delivering industry-beating growth of 20.5% over the same period last year. This impressive performance has been driven by the success of key vehicle models in which the company has a strong presence, coupled with a well-optimized product mix. Notably, the increasing share of LED lighting in the portfolio has further supported overall revenue growth. The company stands as a leading force in the automotive lighting industry, renowned for its extensive expertise and enduring partnerships. With a strong Tier 1 relationship with all major OEMs in India, the company has firmly established itself as a trusted partner in the automotive lighting space. Few updates for the quarter. The company has started SOP for Maruti's first ever EV model, the e-Vitara, at its Sanand facility. Jharkhand Phase 2 will commence operations from H2 of the current fiscal year, which will primarily cater to Skoda and Volkswagen models. During the quarter, the company has successfully launched lighting products for the Tata Altroz and the Maruti Grand Vitara models in the passenger vehicle segment, and for the Suzuki e-Access, Hero Vida VX, and the Mahindra Yezdi models in the two-wheeler space. Lumax Industries continues to demonstrate resilience, agility, and leadership in a rapidly evolving automotive landscape, backed by strong industry partnership, robust innovation capabilities, and a clear growth roadmap. The company remains well positioned to capitalize on emerging opportunities. With a healthy order book of almost 2,000 crore rupees as on date and focus on enhancing operational efficiencies, we are confidently moving forward on the path of a sustainable long-term value creation for all stakeholders. I would like to now hand over to our CFO, Mr. Ravi Teltia, for giving the financial updates.
Thank you, sir. Good morning, everyone. Let me take you through the key highlights of our operational and financial performance for the quarter. Starting with the financials, as our GMD mentioned, we delivered strong top-line growth this quarter. Our consolidated revenue stood at rupees 923 crore, making a healthy 20.5% year-on-year increase. EBITDA for the quarter came in at rupees 85 crores, up from rupees 70 crore in Q1 FY25, reflecting a growth of 20.7%. EBITDA margin improved to 9.2%, up 10 basis points year-on-year. This improvement is a result of continued focus on cost discipline, operational efficiencies, and a growing contribution from our premium product portfolio. Moving to the bottom line, our consolidated profit after tax, including shares of associates for Q1 FY26, stood at rupees 36 crore compared to rupees 34 crore in the same quarter last year, registering a growth of 6%. PAT margin stood at 3.9%. The effective tax rate for the quarter stood at 25.109%. Now turning to the operations side, we are seeing strong traction in the LED lighting segment, which continues to be a key growth driver. In Q1 FY26, LED lighting accounted for 61% of our total revenue, up from 45% in the same quarter last year. This reinforced our strategic focus on LED solutions. Importantly, 84% of our current order book is now LED based, which gives us strong visibility and confidence in further expanding this segment and increasing our market share in the quarters ahead. Looking at our segment mix for the quarter, revenue contribution stood at 65% from passenger vehicles, 29% from two-wheelers, and 6% from commercial vehicles. This well-diversified mix underscores our solid positioning across multiple segments of the automotive market. From a product standpoint, front lighting contributed 68% of total revenue, followed by rear lighting at 23%, with other products making up the remaining 9%. With that, we are now open the floor for questions. Thank you once again.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Rehan Syed from Trinedra Asset Managers. Please go ahead.
Good morning to everyone, and thank you for giving me the opportunity. So, sir, I have only two questions. First, you have mentioned before customer price correction impacting quarter one margins. So, could you clarify the expected quantum of this correction in quarter two and whether they will be backdated? Could you please just put light on more on this?
I'm sorry, you're not audible. Can you? There is a lot of echo at your end. Could you please repeat the question?
Sure. I repeat my question again. So you have mentioned deferred customer price correction impacting quarter one margins. So could you clarify the expected quantum of this correction in quarter two and whether they will be backdated? Could you please put more light on this?
So we've already got price corrections to the tune of almost 13 crores in quarter one, which was pending from quarter four. And again, this is a recurring phenomena. In the subsequent quarters also, we continue to perhaps expect certain realizations.
Okay. As the next question is the green fuel segment side. Green fuel contributed 95% crore revenue in quarter one. So what's the growth trajectory you foresee in the alternate fuel segment?
Sorry, I'm unable to hear you. Maybe you're using a speaker.
No. Okay, I'll shift to my speaker.
So sorry to interrupt, but I request you to use your handset while asking a question.
Ma'am, I'm using my handset only. Okay. Now am I audible now?
Yes, please go ahead.
Okay. So my second question is the green fuel segment. Sir, the green fuel contributed 95% crore revenue in quarter one. So what's the growth trajectory you foresee in the alternate fuel segment over the next 2 to 3 years, and how is hydrogen-related R&D progressing in this side?
Sir, this call is for Lumax Industries Limited. I would restrict the conversation to Lumax Industries Limited. Green fuel is a part of Lumax Auto Technologies Limited, which is another company.
Okay. That's it for me. Thank you.
Thank you. The next question is from the line of Virat from SIMPL. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just a couple of questions. First is, if you see the competitive landscape in four-wheeler lighting, one of the major players also entered into a JV with Tata Autocom. So Valeo lighting system, both Decode and Lumax, Tata Autocom has kind of entered into a JV. So just trying to get a sense, how do you see the competitive landscape shaping up? And a related question is, you also see a lot of other players targeting the ambient lighting and the interior lighting space. So any color you can give how you see competitive landscape within various sub-segments in four-wheeler lighting, and are you seeing any pressure in terms of realization?
So thank you. And number one, on the competition landscape, we do not foresee any major change based on the recent announcements of Ichigo and Taco. Again, Valio was always here, and they are just acquiring the company Valio. Lighting, as I've always maintained, is already having a hyper-competitive scenario in India. Despite that, your company continues to have the majority market share along with its associate company, SL Lumax, for India. Coming to the competitive landscape, I think we are pretty well positioned to competitively continue to maintain our market share and continue to grow our wallet share across OEMs with respect to the future order book. So again, I don't see that as a threat. Also, given the fact that it is perhaps a TACO JV, it would automatically get restricted to entering into multiple OEMs being a TACO company. So that's my comment on the specific joint venture. The second question you had on the ambient lighting, I'm happy to share that the ambient lighting business of one of Honda's forthcoming model has already been awarded to Lumax Industries Limited, and it is currently under development. And going forward, we are trying to rationalize the optimum synergies at a group level, because usually ambient lighting also becomes an integral part of the interior systems. So how do we try and synergize our strengths both on ambient lighting as well as interior solutions as a group to at least offer a lucrative solution to our OEMs. So we are very much working on ambient lighting as a product at a group level.
Got it. Thank you. Second, one more question I had was on the order book. So if you look at the current revenue mix, you still have fair representation from two-wheelers as a category. But if I look at the order book, incrementally is more skewed towards four-wheelers. So is it more to do with the focus for us relatively being more on four-wheeler as a space, maybe because the TAM is higher and the play is more higher, or any perspective we can give how are we going about this?
So first you have to understand, currently the company sits with a 61% revenue mix from passenger vehicle segment. Actually, it's 65% from passenger vehicle, and it's about 29% from two-wheeler. The value, the content per vehicle on a passenger vehicle for lighting is almost close to 7 times that of a two-wheeler. And that's the reason when you look at the value-wise distribution, the passenger vehicle will always outperform the two-wheeler. So again, 80% of our order book comes from the passenger vehicle segment. And again, keeping that in mind, we do not expect any significant change to our overall segmental pie.
Understood. Last query, if I may. You've seen a very good success with scaling up with HHMI, right? Can you give some more perspective what model wins we have won, commercialized, and whom we are taking share? Any color you can give more on this?
You're talking about HMSI?
Yes.
So HMSI, we continue to maintain a very strong wallet share of almost more than 50%. Specifically on the front lighting, I do believe our share is anywhere between 60 to 70%, and the order book also continues to maintain that wallet share. So we are across models of HMSI across their facilities, both in North as well as in Gujarat and in Bangalore.
Got it. So, the said customer, they have a very strong pipeline, both in EV and ICE. So in terms of incremental pipeline also, any color you can give? Are we there are we able to maintain a similar share or,
Yes, absolutely. We have an order book of HMSI as well. Almost, I would think close to about 50 to 70 crores out of this total order book would be of new models of HMSI.
Okay. Thank you and good luck.
Thank you.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and one on their touchtone telephone. The next question is from the line of Mihir Vora from Equirus. Please go ahead.
Yeah, thanks for taking my question. So, sir, firstly, the clarification on this ambient lighting front. So, when we say as a group, we'll be providing the solutions to the OEM. So, is it that ambient lighting production can also go to the Lumax also, or it will be in Lumax Industries only?
So, it really depends on the customer ask. And again, ambient lighting, there could be a mix that there could be certain customers who could be catered to from Lumax Industries. There could be certain customers who could be catered from Lumax Auto Technologies, this subsidiary IAC India. Again, maybe the engineering would rest in Lumax Industries, but in terms of production and integration with the interior modules could happen at Lumax Auto Technologies. So that's something which again would be more driven from the customer's, let's say, ask rather than more of an internal strategy. But I do believe that ambient lighting as a first step, we have started already at Lumax Industries Limited.
Right. And sir, in terms of production, how would this ambient lighting production be different than our LED lighting?
Well, it's the science behind it is similar, but again, the ambient lighting could be very, very different, again, based on the kind of features and the kind of mood lighting which is there from the customer. From a product standpoint, it's fairly simple, but again, the idea is how much of an integration with the software we can do, and that's again what the bigger challenge would be. But it is a much simpler product compared to, let's say, the front lighting or the rear lighting in terms of the product specifications.
Right. Okay. And sir, any broader range of only if we consider ambient lighting, what would be the content in a broader range? And like there would be, depending on the coverage, you may have a dashboard ambient lighting or a full car ambient lighting. But any broader range here in terms of content value?
It really depends again on the customer ask and the model. In our initial estimates, we've seen the range go from anywhere between 1,000, 1,200 rupees per vehicle all the way up to 10,000 rupees per vehicle. So again, it would hugely differ based on what the customer wants as an experience inside the cabin.
All right. Okay. So, and my second question, sir, was on basically I was going through the SL Lumax number for FY25. The margins there have been quite good and the profitability has been good, which is reflecting on our share of associate numbers also. But going ahead, do we expect this kind of performance from SL Lumax to continue? Because around 60% of your PAT is derived from this share of associates. So that is the reason I'm asking this question.
So again, SL Lumax continues to be a very symbiotic partner for Hyundai India. I don't see any reason why the performance would drift from where we are currently and historically. My only comment there is that rather than looking at SL Lumax's performance on a quarter-to-quarter basis, because there are a lot of price corrections, adjustments which happen with Hyundai, it is better to look at it from an annual perspective and then compare it to a year-on-year growth. So, but I don't see any reason why the performance would, going forward, change.
All right, sir. Okay, sir. That's all from me.
Thank you.
Thank you. Before we take the next participant, a reminder to the participant, anyone who wishes to ask a question may press star and one on their touchtone telephone. The next question is from the line of Harshit Javeri from PI Square. Please go ahead.
Yes, sir. Good morning. My first question would be towards our localization efforts. So, sir, if we see the cost of raw materials is shooting up, I think this is due to the high value imports. So what is the status on our localization efforts?
So number one, I think if you look at our raw material consumption for the manufacturing part, we've actually improved that on a year-on-year basis from 65.1 to 64.3, and also on a consecutive quarter-on-quarter from Q4 to Q1, it's gone down from 66.5 to 64.3. There are multiple reasons for it, one of them being the product mix. But more than that, the localization efforts which were kick-started last year, they have now started to come in from Q1 onwards, and that's why we do expect that going forward, we should be able to maintain our raw material consumption between 64 to 65.5% or so. But the localization efforts are starting to be seen from Q1 onwards, and we continue to drive further localization efforts throughout the year.
And sir, with a higher concentration in the passenger vehicle, with a higher reliance on Hyundai and Maruti, and you said in the industry outlook that passenger vehicle is still facing some inventory challenges. So how do we plan to mitigate this, and how do we plan to have that double-digit growth trajectory going ahead?
I think despite the muted quarter, you can see that the company has reported a 20% growth. And again, while the overall industry volumes seem to be under pressure, there are also certain outliers like, for example, Mahindra and Mahindra, which have actually shown a very robust performance for their quarter one, and they continue to be very, very buoyant and optimistic for the remaining part of the year. Again, the company is privileged to have such a diverse customer base. Again, I do believe that our growth is coming mainly on account of higher wallet share and the deeper penetration of LED, which actually goes to a higher content value per vehicle, and hence our growth will always be outperforming the industry growth, whether it's passenger vehicle or even the two-wheeler segment. But again, we remain cautiously optimistic about the current financial year going ahead.
Okay. So last question on the margin front. We saw a dip of around 60 basis points on the PAT margins. Any specific reason? First, due to SL Lumax. Secondly, how do we see the recovery in the PAT margins in the coming quarters?
This side, Ravi, so especially on SL Lumax, in the quarter one, there are certain dip in the margin part, and that is because some of the profit-generating models of SL were not picking up. So that's why on the SL impact is there. But if you see our PBT level, which is there, therein we are showing the growth better than the profit growth. Like our sales growth is 20.5% and our PBT growth is 26.6%. And in terms of the coming quarter, we are maintaining the margin on the upper side only in the range of say 9.5 to 9.8%. That's what we are forecasting.
Okay, sir. Thank you and all the best. I'll join in.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and one on their touchtone telephone. The next question is from the line of Apurva Mehta from AM Investments. Please go ahead.
Hi, sir. Congratulations on decent numbers. So, the employee cost from Q1 has gone up substantially. Is it anything one-off in that?
Sorry to interrupt. Your voice is not clear. I request you to use your handset while asking a question.
Hello?
Yes, go ahead, please.
Yeah. So congratulations on decent numbers on the top line front. Just wanted to ask that the employee cost Q1 has gone up substantially. Is there any one-off, or is it that Q4 is always where we take adjustments and that's why that was lower, and Q1 is where the price hikes are there, that's why?
So I'll just say, I think Q1 usually is from the annual appraisals and annual inflation. Usually there is a higher aspect which kicks into the beginning of the financial year. But again, if I look at it purely from a point of view of percentage to sale compared to Q1 on a year-on-year basis, there is an improvement. I do believe the overall manpower cost dropped from 13.5 to less than 13%. But we do expect this to be within the 12 to 13% range as we go forward as well.
So it will, over the period, it should rationalize.
Sorry, can you repeat that?
Yeah, over the period, it should rationalize, I think.
Yes, that's correct. I think we are looking at a further growth on a every quarter basis on our revenue. From a 850 odd crores revenue, I do expect possibly a double-digit growth on top of this into Q2. So as we move forward, we will also get those fixed cost benefits on the manpower cost, and yes, the percentages will get rationalized.
So the full year target of around 20+% growth is still intact, and should we see that the margin improvement going ahead?
So that's correct. I think the forecast for the current year continues to be anywhere between 15 to 20% in terms of the top line growth. Also at the EBITDA margin, I think currently Q1 we are at 9.2%. We've seen almost close to 100 bits expansion on the manufacturing EBITDA compared to year-on-year Q1 FY25. So we do maintain that, I think, as Ravi mentioned, a 30 to 50 bits improvement on our EBITDA margins going into Q2. And for the full year, I think the forecast remains to be in the double-digit EBITDA space on the back of this 15 to 20% top line growth.
Sir, the line for the current participant has been disconnected. Can we move on to the next participant?
Go ahead, please, sir.
The next question is from the line of Heath Vora from Guardian Capital Partners. Please go ahead.
Yeah, good morning. Just one question on the Chakan Phase 2. So when do we expect commercial operations to begin, and how do we expect the ramp up in this plant?
So basically in Chakan Phase 2, as we mentioned, we are expecting that the SOP will start by end of this quarter or early next quarter. That is the focus there. And the peak revenue which we are expecting, that is sometime in FY27, is somewhere around 250 to 300 crore from Phase 2. And primarily we will, as we mentioned, we are catering it to the Skoda and Volkswagen group.
And just one more question was on the debt side. So while the finance cost has been constant, I just want to understand, how do we expect the debt to move going forward?
So we are maintaining that in the current financial year, we are not looking at any new long-term debt. So we will continue to pay our long-term debt as per schedule, which is somewhere around 70 to 75 crore. And with this, we will only the working capital part, some increases based on that's the update about it.
Understood. Thank you.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. The next question is from the line of Saurabh Jain from Sunidhi. Please go ahead.
Hello. Congratulations, sir, for a wonderful set of numbers. So I have a few questions. First, to begin with, on the split of order book, if you can provide some broader perspective, who are the major customers building up this order book, like you had talked about it in the last quarter also.
So from an order book perspective, more than half of the order book is coming from Maruti Suzuki India, followed by Tata Motors, Mahindra & Mahindra, and Honda Car India, almost at an equal proportion to the order book. And in the two-wheeler space, we have TVS and HMSI as the front runners of the order book. That's just a pie of almost close to 80% coming from these 5 odd customers. After the Maruti Suzuki's order book, we do expect a significant increase in our wallet share within Maruti Suzuki's both front lighting and rear lighting as well. And again, from an order book perspective, the entire order book should be realized by FY28 and maybe some residual in FY29.
Okay. And sir, how much of this 1,900 crore plus order book to flow in current fiscal?
So almost half of this will come into the current fiscal. About 30% will be in the next fiscal, FY27, and the remaining 15 to 20% would be in FY28 and maybe some part in FY29.
Great. Thanks. Sir, my next question is on EBITDA margins. Of course, you have mentioned about, manufacturing EBITDA margin, but we are looking at, overall EBITDA margins, which were one of the best in last 5 quarters at 8.9%, vis-a-vis, 8.9% in the current quarter and 8.6% in previous quarter. Which was almost 140 basis points on YOY basis improvement. So now that order book is now flowing to SOPs, and does mold revenue likely to command lesser share overall in revenue pie? So
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.